It's January 18th, 2026. Your screen is lying to you. Silver is down over 3%, gold is sliding. The headlines scream this is the end. But while that emotional flush happens, one metal holds with terrifying stability. Copper, $5.86 per pound. Welded to the floor, I saw something today I couldn't wait to report. While everyone watches the exit, I watch the VIP entrance. Amazon Web Services just bypassed the entire public market. A 2-year direct offtake deal with Rio Tinto. Samsung, too. These aren't speculative trades. They are strategic acquisitions of a resource these giants cannot be without. If copper is about to crash, why are the biggest corporations locking in multi-year supply now? The screen tells one story. The shadow market tells another. This isn't a market rotation. This is the moment copper stops being a commodity and starts being treated as the strategic asset it is, the new gold. Institutions are front-running the public before most realize a shortage is coming. Here is my primary claim. Copper is no longer a commodity. It is becoming a strategic tech asset that Amazon, Samsung, and every major player in AI and electrification are securing before the public wakes up to the structural shortage. This is a fundamental shift. We are witnessing the great decoupling. Silver and gold are fear trades, insurance you buy when scared. Copper is infrastructure oxygen, the metal you need to build the future. AI data centers, EV fleets, renewable grids. Every piece of tech for the next 20 years needs massive copper. The uncomfortable truth? Supply cannot respond for at least a decade. It takes 12 to 15 years to bring a new mine online. Ore grades have dropped 30% since 2000. The easy copper is gone. Demand accelerates at an insane pace. So here's what I will do. First, walk you through the exact market structure right now. Second, break down the macro rotation, the copper to gold ratio. Third, run the actual supply-demand math. Fourth, steelman the strongest argument against this. Finally, share my personal battle plan and triggers. This is a cycle signal building for 175 years. By the end, you'll understand why the real story isn't the red flush on your screen. It's the shadow withdrawals at the LME nobody is talking about. On the ground reality. January 16th, afternoon EST. Gold, 45.888.12, down $21.84. Silver, 88.55, down 3.15%. Copper, 5.86 per pound. That copper price is critical. While precious metals get hammered, copper holds. Not rallying, just holding. In this market, that stability is more telling than any moonshot. Look at the CFD structure, a high liquidity battle zone at 586. Despite the panic, despite every reason to sell off, it refuses to surrender the 550 to 580 support. I call this tectonic stability. Large hands are underneath this market. Contrast with silver's red flush, emotional, volatile, driven by paper traders selling from fear. But the paper and physical markets tell different stories. While paper dumps silver, physical giants like AWS sign 2-year deals for copper. Amazon isn't speculating. They are securing multi-year supply because they've done the math. They bypass public markets to guarantee that supply. This is unusual behavior during what the mainstream calls a crash. What do they know that the paper markets don't? The silver flush is real. The fear is real. But the shadow withdrawals at the LME are real too. Institutions tell you to sell the metals crash, while they hardwire their data centers with the very thing you're told to ignore. When the disconnect is this large between screen and physical market, pay attention to the physical market. The screen can lie. You cannot print copper mines. The macro rotation. We must discuss the copper to gold ratio. This is the economic seesaw. It is tilting now. The ratio measures market preference between two different assets. Gold, the ultimate defensive asset, the insurance policy. Copper, the industrial workhorse, the infrastructure metal. Gold is what you buy when scared. Copper is what you buy when building. When the ratio falls, the market rotates into defense, recessions, crises. When the ratio rises, the market rotates into offense, growth, building. Here's the trap for precious metals holders. When the ratio turns higher, it signals a shift towards industrial utility assets. If you hold only defensive assets, then you're positioned for the last war. Technically, the ratio just completed an ABC flat correction. The consolidation is over. The seesaw is tilting. I'm not saying gold will collapse. I'm saying the market is starting to favor the metal representing growth over the metal representing fear. This is a slow, grinding rotation. The early movers, institutions, tech giants, are not waiting for CNBC. They position now. If you only watch gold and silver, you miss the bigger picture. The era of pure defense is giving way to strategic offense. Copper is the tip of that spear. An analogy. In a war's early chaos, you stockpile ammo and dig bunkers. That's gold and silver, the fear trade. To win, you must go on offense. Build supply lines, manufacture tanks. That's copper, the growth trade. The copper to gold ratio says we are shifting from bunker mentality to build mentality. Interrupt. This is not theory. Look at the AWS deal. Look at Samsung. LME inventories decline while corporate offtake accelerates. The rotation isn't coming. It is already here. The math. We must run the numbers. Demand. The EV and grid gap. A traditional car uses about 20 kilo of copper. An EV uses about 80 kilos, 4 times more. Every major automaker commits to full EV lineups in 10-15 years. Global production, 180 million vehicles a year. If half transition in a decade, that's an additional 2.4 million metric tons from autos alone. AI data centers. A new wildcard. A single large data center needs 5,000 to 10,000 metric tons of copper. We are building hundreds. Microsoft, Google, Amazon, Meta, all in an AI arms race. Every watt requires copper. Renewable grids, solar, wind, grid-scale storage. An offshore wind turbine uses 8 metric tons. A solar farm uses 5 to 12 metric tons per megawatt. The IEA says we must triple renewable capacity by 2030. Add EVs, AI, renewables, and baseline demand, a multi-decade locked-in demand profile. This is structural, not cyclical. Supply. New mines take 12-15 years, discovery to production. Ore grades dropped 30% since 2000. Miners move 30% more rock for the same copper. What's left is deeper, lower grade, more expensive. A stress test. Assume 3% annual demand growth, conservative. Current demand, 25 million metric tons year. We need an additional 750,000 metric tons every year just to keep pace. The pipeline can't meet this. S&P Global projects a cumulative supply deficit of nearly 10 million metric tons by 2030. 10 million metric tons is a structural gap. Recycling myth, yes, 30% of supply is recycled, but recycled copper cannot meet high purity standards for AI cooling or next-gen EV circuitry. You need virgin material. Recycling helps baseline demand, but not the high-tech gap. The price math, $5 per pound, isn't hype. It's the new floor. All-in sustaining costs approach $4 per pound. A $1 margin doesn't incentivize massive new projects. To justify new mines, prices need to be sustainably above $6 or $7. The market hasn't priced that in. We face a tectonic grind, a slow revaluation as physical metal disappears into corporate supply chains faster than new supply replaces it. Steelman the Skeptics. The strongest counter-argument, recession will kill demand. A prolonged global manufacturing recession. If credit tightens, if green spending pulls back, projected demand evaporates. Copper, being cyclical, gets crushed. This is legitimate. My response, yes, copper is cyclical. A recession would hit demand. But the corporate deals show tech giants care about availability, not the PMI. AWS isn't speculating. They are de-risking supply chains. If they wait for a crash to secure supply, the supply might not be there. Past cycles had fungible demand. You could delay projects. Today's infrastructure demand is not fungible. It's not optional. Amazon can't indefinitely delay an AI data center. Automakers can't pause their EV transition. This is locked-in demand. A recession could slow the transition, delay projects. It cannot eliminate the structural need for electrification. Crucially, supply can't respond quickly, even if demand slows. In a recession, miners cut exploration, delay projects. When recovery comes, the supply deficit is worse. You can't idle and restart a mine quickly. A pause adds years. The recession argument reinforces the long-term structural case. Second skeptic argument, recycling will save us. Reality, recycled copper cannot meet high-purity needs for AI or advanced EVs. The metallurgy doesn't allow it. Recycling cannot fill the high-tech gap. Third, China slowdown. China is 50% of global consumption. A slowdown would hurt. But China is also the largest investor in renewables and EVs. Electrification demand there accelerates. Beyond China, India, Southeast Asia, Latin America are building. Demand is becoming more globally distributed. A Chinese slowdown hurts, but doesn't eliminate the global structural story. Conclusion, recession risk is valid for short-term volatility, but the structural supply deficit, locked-in demand, and supply inflexibility are real. For a multi-year trend, the bear case doesn't hold. You cannot print copper mines. What happens next? Watch the institutional reaction. I monitor LME COMEX for margin requirement changes. Rising margins plus accelerating shadow withdrawals signal paper market stress. That's when price discovery breaks. Shadow withdrawals. LME reports only registered warehouse stock. It doesn't show copper pulled into private corporate stockpiles via direct deals. AWS and Samsung copper won't be on the exchange. Official inventories can look stable while spot supply evaporates. This is a dark inventory phase. Lithium already went this way. Media narrative, they will focus on silver's volatility. Volatility generates clicks. The narrative will be metals crash, while institutions quietly secure copper off exchange. Classic misdirection. My dashboard. 1. LME inventory levels. A steady grind down while offtake deals rise confirms the squeeze is moving off exchange. Availability, not price, becomes the clearing mechanism. 2. The 550 floor. If copper holds above this during the next broad sell-off, it confirms a permanent decoupling. Copper becomes a strategic asset with a structural bid. 3. Futures versus physical premiums. Widening physical premiums signal a tighter spot market than paper prices imply. This won't happen overnight. It's a multi-year grind, likely next 12-18 months. Volatility in gold, silver. Copper grinds, hold support, doesn't go down. Corporate deals continue. LME inventories decline. Mine projects get delayed. Sometime in late 2026 or early 2027, the market wakes to the structural shortage. The real move happens then, not from speculation, but because the physical market has been cornered. My personal battle plan. Not advice. My triggers. I watch the copper to gold ratio daily. If it turns higher while silver is suppressed, I rotate focus to industrial tech metals. I'm not selling my physical silver. That's my insurance. But for asymmetric upside, I shift to copper exposure. For retail, copper mining equities offer asymmetry. I look at the Global X Copper Miners ETF, ticker COPX, diversified exposure without single stock risk. My triggers. Trigger A. Copper closes the week above 580 despite a broader market sell-off. Stocks down, precious metals down. That confirms the structural bid. I increase exposure to COPX. Trigger B. Copper sustains a break below 520, weekly close. That signals recession fears are winning. I step back and wait for a new base. Interrupt. Stop. Watch the bid-ask spread on copper CFDs. Liquidity is drying up. Market makers are nervous. When liquidity dries up in a supposed bear market, it often means the bear phase is ending. The battle is won in the spreads, the open interest, the early morning warehouse reports nobody reads. My plan, watch copper daily, the ratio weekly, track LME inventories and corporate deals. If copper confirms strength above 580 amid weakness, I rotate into COPX. If it breaks 520, I'm out. I keep my physical silver as insurance. The goal isn't getting rich quick, it's positioning on the right side of a multi-year structural trend. The biggest commodity moves happen when institutions position quietly, and retail is distracted by something shinier. Silver is the shiny distraction. Copper is the quiet, structural move. Recap plus forecast. 3 sentences. Silver is the headline. Copper is the long chapter. The AWS and Samsung deals are the first drops of a corporate tsunami bypassing public markets. The macro rotation from precious to industrial metals has begun. The market just hasn't announced it. My forecast. Next 12-18 months, copper grinds higher, frustrating everyone. A choppy slog building a higher floor. Underneath, corporate chains tighten, LME stocks fall, mine development stalls, demand from EVs, AI renewables accelerates. The paper price must reconcile with physical reality. It won't be gentle. $5 per pound is the new floor for a world with no choice but to electrify. If you understand copper's transition from commodity to strategic asset, you understand why institutions position now. The rallying cry, don't let the red flush blind you to the tectonic shift in the dirt. The era of copper as just an industrial commodity is over. The era of copper as strategic tech gold is here. While the media writes obituaries, the smart money hardwires the future with the one metal that can't be printed, synthesized, or substituted. You can ignore it. Wait for CNBC. Or look at what AWS, Samsung, every tech giant building the AI-powered future is doing. They secure copper directly off exchange, above market rates. They aren't speculating. They are acquiring a strategic resource they know they cannot be without. The question is, will you position for the world as it was, or the world as it's becoming? The metals crash narrative is for yesterday. The copper supply crisis is for tomorrow. And tomorrow is closer than most think.